Hey, you Rent to Retires. It's Adam Schroeder here with another episode, and I am pleased today to be joined by Ivan Barratt. He is the founder and CEO of the BAM companies. He's a multifamily owner, fund manager, syndicator, specializes in large apartment communities in the Midwest. He's been doing this for a long time, over a decade, working in the real estate world. So, Ivan, thanks for joining me today.
Yeah, Adam, it's great to be here. Been looking forward to this show in particular.
Yeah, excellent. So we're going to start where we start with everyone, and that is tell us about your first real estate deal and then why that kept you in the real estate world, whether it was a success or not, why you stayed in real estate after you had your first deal.
Yeah, sure. So I'd have to go back quite a ways. I've been in real estate 25 years, and luckily, fortunately, my father had rental properties growing up. My brother and I were his landscaping arm all summer long. And 1996, graduated high school. My dad gave me Rich Dad Poor Dad. So that was an early sort of seed planted in being successful in real estate. And my first deal was a owner occupied duplex. My father said, "If you buy a duplex, I will match your down payment." And so I've lived in one side and rented out the other. And yeah, hated being a landlord at the time and dealing with the tenant next door. But eventually I would become quite a big landlord. And yeah, stayed in the business, worked for a developer for several years, got to wear a lot of different hats, see a lot of different real estate deals, all the way through the process from feasibility all the way to selling the end product to the end user. And 2008 hits, learned some very important lessons at that time. And in 2010, used my broker's license, which I'd picked up along the way, to start a real estate management company. You had to have a broker's license in the state of Indiana, like most states. And I built that service-based business first. So unlike a lot of syndicators out there, I started in the property management game and built that and used that service company to build a team and build an infrastructure. And I bridged into doing my own syndication deals, did several of those, and used that to get into the fund management space once I had a long enough track record of exits, and used the fund management vehicle to build out a capital financial services team that handles almost 1,700 investors now across the country and even outside the U.S. And that has enabled us to work in several different strategies now, from acquisition funds. We give our investors the opportunity to invest in the credit side of the house. And we also do joint venture developments with great developers that need a capital partner.
Yeah. So you're saying you became a big landlord. So you don't own apartments and you don't live in one of the apartments and tell everybody there that you're managing the whole place.
No, not anymore. Not anymore. No, we've done almost 9,500 units so far, mostly acquired, and about maybe 1,200 units under development as we're talking.
Nice. So tell us a little bit. There's a lot of people recently who've been concerned that the housing market is going to go the way of, '06 through '08. How did you survive that time? And then do you see any situation right now where people should really be worried about that?
Well, back to 2008, I ended up falling off a cliff with lots of development projects that I was basically the in-house broker for, and was going to make a lot of money when everything sold, and then everything stopped. And I found myself $200,000 in debt, negative $5,000 a month in cash flow, and had to really dig out of that. And so those were some pretty formative years, and forever changed my DNA as a real estate investor. And coming out of that, did some of my best deals. Now, they were small deals, so the percentage returns were high, but the dollars weren't, because they were smaller multifamily deals. And then to answer your second part of that question today, we've been in a multifamily correction for a while. So it's been a pretty terrible time to sell, Adam, but it's been a great time to acquire for those of us that can fill out the capital stack and still raise debt and equity. It's been an amazing time to buy. A lot of things rhyme with 2010. Not a lot of capital in the system. Liquidity's dried up, which creates more opportunities for those that can execute. it's easy to say be greedy when others are fearful, but it's a lot harder to execute, which is why the deals can be so phenomenal. As far as single family homes, I am seeing a lot of data and news that certain markets, especially like South Florida, Austin, Texas, where you're located, in other what I would call COVID boom markets where the prices have gone so far above the mean, you're now seeing mean reversion. And so you're seeing a lot more inventory. You're seeing new homes sit, and you're seeing some prices come down in a lot of markets. Does that mean it's going to be 2008? I don't think so. '08 was more like an 80, 90 year, super cycle event. In some ways, it would be great if it was that deep of a recession. I don't think it is, but I think you're going to see a lot of corrections in many of the markets out there on the single family home front.
Yeah. So let's talk, your dad matched your down payment for your first duplex. I doubt that he matched your down payment on your first multifamily and was a 50% owner of that. So how did you manage to scale up? Because most people don't just go from I own a duplex to I own an apartment building with 100 doors.
Sure.
What are the steps that lead there? Because one of the things that you say is, think big, start small. Well, then if you think big and start small, how do you get to think big and act big?
Yeah, it's one step at a time. One of my mentors said, start wherever you're comfortable and continue to move up. And so bought duplexes, small apartment buildings. My first apartment deal was a 6 unit. Then I bought a 35 unit, a 30, then a 15. And then my first, what I would call syndication light, where I did have a group of investors that were more traditional LPs, was a 60 unit, and then just kept jumping from there. The management company really laid the foundation and gave me credibility with those early LPs, some of which were the folks I was managing small properties for. And when I showed them a business plan for a much bigger deal and how we were going to turn it around and add value, they were interested to invest. And so we could spend 2 hours talking about all the steps, but the main one I'd want to get the point across to your audience that might be thinking about growing a business is beyond the real estate, it's much more of a people game. And I can go really fast, really, really far by myself, right? But if I want to go farther, I've got to bring others with me. And so figuring out managing people, leading people, growing teams that can execute, knowing what I'm good at and knowing even more importantly what I'm not good at and what I shouldn't be doing, and bringing in people that have those skill sets is mission critical.
Yeah. So to meet those people, were you going to like RIAs? Were you going to conferences? Were you just online? Because I mean, a lot of very, very few people who are listening probably own property management companies like you did, where investors come to them and then you meet investors because obviously you're managing their properties and all of that. But how did you start growing your actual network so that you could, you know, get that reputation and, build up the ability to scale up to, hundreds of doors in one complex?
So I was more referring to first bringing people on the team, employees, and growing a team that can execute. And that helped me have credibility in the marketplace. But back in the early days, Adam, my first CRM was a note file on my phone, and I listed everybody in Indy that I knew that I thought was rich, and just started taking them out to lunch, coffee, breakfast, meeting them at their office, or however I could get on their schedule. And there's an old saying: if you ask for money, you get advice, and if you ask for advice, you get money. And so I would just go and meet with these people and show them my business plan and ask them for advice and what they thought about it. And a few of those people would become investors, and started building some momentum by getting referrals from my current investors who were seeing returns on some of those earlier deals. So fast forward to today, we spend all kinds of capital on advertising and customer acquisition for new investors, but our number one driver of new investment is referrals from current investors, because some things don't change, Adam. You take care of the client, you communicate, transparent, even when things aren't going well. They'll tend to tell a couple people about their experience, and lots of people like to talk about real estate.
Yeah, absolutely. Especially, it's amazing to me whenever real estate investors get together and talk just how open and transparent they are. Like, they'll show literal cash flow statements and, do all of this and that and the other. Whereas opposed to, if you work in an office and you ask somebody, how much do you make? Suddenly things get weird, right? But when it comes to real estate, it's like, oh, how much are you cash flowing on that property? Or what's your ROI on this? And people are just like, oh, I make $500 a month, or my ROI is negative 13, but hey, I'm still in the deal and blah, blah, blah. It's a whole different world from, a lot of like corporate America and that kind of stuff. So it's
Absolutely.
place to be.
Yeah, no question.
So tell me about, on the flip side, not you, but whenever you went to and started raising money, and for people who are thinking about doing something like this, how do you vet an operator? Like what do people need to be looking for to see, you know, what do they say? Don't tell me about the return on my investment until you tell me the return of my investment. You hear about, potential syndications gone bad. Some syndications work out really well, but obviously the biggest thing is the team that you're investing with. How do you vet the team? Because in single family, it's really easy to evaluate the home, get the rental, get the property management. It's one property, you can do it yourself. But whenever you're vetting out a team, what are the important things that people really need to be looking at whenever they're going into that?
Yeah, it's another great question, one we could spend a lot of time on. So I'll try to be brief here. But at a certain level, like for instance, my team is audited, so all our financials, everything we say we've done, from returns to annual financials on any given deal, is all audited by an outside national accounting firm. Now, obviously, not every team's going to be that far along, and being able to provide all of that. It's not cheap if you're doing little deals. It gets more easy to add the expense when you're dealing with funds. For small investors that are just looking to get started in this, there's probably somebody in their own town that they've got a personal relationship with, that they already know and trust, that might be a good person to put a little bit of money with. Some of the big ones, though, investor references. I've had people do background checks, right? And gosh, there's just so many things in that checklist. I think, we talk a lot about passive investing. For the investor that's out there allocating to different sponsors in different asset classes, there's no such thing as passive. It's a very active game. It requires a lot of education. I often tell folks, look at a lot of offerings, read a lot of different decks, and you'll start to get more of a fingertip feel for what should be in the deck and what, might be a red flag or might be missing.
So tell us, whenever, as an operator, what are you looking for in a deal? Because there's, like I mentioned, a lot of the people who are listening are single family investors. Is it the exact same thing whenever you're going into a multifamily investment, or are there different factors that people are evaluating, and most importantly, you're evaluating whenever you start looking at a potential opportunity?
Yeah, in some ways there's some overlap there, and in other ways it's a whole different animal. It's truly an operating business. It's got its own P&L. It's got on-site staff. When you're talking about the size of units that we buy, we're typically 200 to 400 unit apartment complexes that are Class A communities with all the amenities that white collar residents who pay high dollar rent are looking for. And we still have to have, even though we're buying Class A, Adam, we still have to have some sort of ability to add value. If we can't fix an undermanaged asset, we used to do more renovations. Now we're looking for folks that are screwing up or being mediocre on the operations versus physical renovations. So we've got to find somebody that's screwing it up. Luckily, in my business, the saying goes is there's always somebody somewhere screwing it up. And we've got to have a market where we know that rents are going to grow. There's good demand. There's steady, consistent population growth. There's diversified employment. Schools is another big one for us. And when you're buying newer, nicer properties, they're actually more liquid because there's a lot more buyers out there that are always looking to buy nicer cash flowing assets.
So where are those markets that y'all focus on? Because we with like I said, a lot of our investors know how to look at single family markets. It might be the same thing, but is there something different about markets for multifamily than there is for single family? Where are y'all doing the majority of your investing? I assume it's around the Indy area where y'all are. It's kind of the hub because that's a you know great market for investors. It's one of the top ones for single family investors for since the Great Recession. So where are y'all looking?
Yeah, we've got a big concentration here in our own backyard in the Indianapolis metro. We're what you'd call suburban garden buyers. So we don't buy inside the loop here in Indy. We're looking at the nice suburbs around town. And most of the time, gosh, probably all the time, it's a good housing market where we're buying as well, where incomes are high, single family is healthy, but there's lots of folks that need to rent as well. So we're in 7 states, and any city we're looking at mirrors a lot of what Indy looks like as well. So the Kansas Cities, outside Pittsburgh, there's some great suburbs. Des Moines, Iowa, we bought 1,200 apartments there. And some other areas, but they all kind of rhyme, Adam, in the fact that they've got great schools, they've got a great jobs picture, there's steady growth and in-migration, healthy suburbs with good leadership, and very importantly, great landlord laws, to where if somebody's not paying the rent, we can move them out in a reasonable amount of time versus some of the urban areas of the country where they're dealing with a lot of difficulty and gosh, a lot of a lot of negativity around property owners, and so we avoid those areas. And the Midwest overall has got some great tailwinds. It's been a flyover state or flyover area for big institutions. There's a lot of people that want to live here, and so I could get better cap rates, better multiples on the deals. And it's the tortoise versus the hare when it comes to growth. But you're seeing a resurgence in manufacturing, advanced manufacturing, pharmaceuticals, batteries, advanced automotive, all kinds of tailwinds that give me comfort in placing bets in multifamily in those markets.
Yeah. So what kind of cap rates are you looking for? Because cap rates, obviously, when interest rates changed, the cap rates changed. Whenever pricing shot up, everything changed. So what is a reasonable cap rate in these markets for people? Because, some people are still looking for, obviously, if they're looking for value add, they might be looking for 8, 10, more than that for cap rate. What's a reasonable thing for a multifamily investor to expect in today's world?
Well, first and foremost, there's lots of different categories in multifamily. And even though we're value add, we're still buying Class A assets. More important than the cap rate, which may start in the low to mid 5s for a Class A asset in a great suburb, it's more about what we can do with the cap rate after we close on it. So we've got to have a high conviction that we can move that cap rate 150, 200 basis points by bringing in our management team, our operational know-how, our economies of scale, and the ability to grow rents and reduce costs due to that. And so a mentor used to say to me, I don't care what the cap rate is. I care what I can do with that asset to increase the value of the asset. So that's really the name of the game. But I would not touch anything that was an 8 to a 10 cap. That is typically going to be a C asset in a C area where you've got a lot of headache and expenses that might not show up in your pro forma until it's too late, and you're in the trenches dealing with bed bugs and drugs and tenants who don't pay and old assets that need a lot more repairs than you might have imagined.
Yeah, it's like when people say the 1% rule, but then like, oh, you really need to buy the 2% rule. And I'm like, if you're buying the 2% rule, good luck. That's gonna look real good on paper, and then something's gonna happen, and it's gonna look real. You're gonna be at the 0.2% rule before it's all said and done. So
yeah, I mean, the whole reason I exist and why BAM exists, Adam, is because there's lots of folks out there that want to own quality real estate. They want the cash flow, they want the tax advantages, they want the capital appreciation, but they've got a career, they've got kids, they've got hobbies, they've got travel, passion, whatever it is. They're really busy already and they don't want a second job. And so they're able to partner with firms like mine to get that exposure to really high quality real estate. And the quickest way to end all this is for me to screw that up by doing bad deals.
Yeah. So Zach would murder me, as all the listeners know, if I didn't ask about one of the things you just mentioned, and that is the tax advantages. Because if you get him started, you better strap in for an hour-long conversation. So talk about the tax advantages that come from this, because a lot of people might be thinking, well, if I'm handing this off to an operator like this, then I'm not going to get as many tax advantages as I could if I were managing my own single family. So what tax advantages
Sure.
are people able to take advantage of investing in, I believe you'll call it the BAM fam?
Yeah, we are the BAM fam. Thanks for noticing. Yeah, so by buying these really big deals and performing cost segregation, they used to call that component depreciation. And now, thanks to the big, beautiful bill, it's been accelerated again. We can drive massive paper losses to the LPs, which are the investors that invest alongside us, and they get their pro rata share of those losses. So, for instance, this year, every dollar invested in our acquisition fund should return at least a 70% paper loss for 2025. So, folks that already own real estate that they may have a gain in can offset that gain. We've had a lot of investors that are selling rental property instead of 1031 exchanging. They're just investing in our funds and using those losses to get the same effect as a 1031. It can offset additional income. There's additional advantages if you're also a full-time real estate professional and want to partner with us. So there's a lot of ways to defer taxes, which is a big game of the wealthy. The farther out I can kick that tax bill down the road, the cheaper dollars in the future to pay it back is a huge advantage than having to pay it in real time. And so big real estate deals offer big offsets, big tax deferrals for the individual investors that come along. And again, that cost segregation where you're getting all the components to the real estate and depreciating them all in year one instead of over a 5, 10, 25, 30-year schedule generates a lot of tax shelter.
Yeah. And I want to ask, kind of as we get close to wrapping up here, obviously you've done a lot of deals, you've got a lot of doors. Tell us about your favorite deal, whether that was, something where you were able to skyrocket returns, you just really love the area, or maybe it was a value add back at the beginning. What was your favorite deal that you've done so far?
Yeah, I think it's going to be Oakdale Square. We are in the process of selling that asset. We've owned it now for several years. When we bought it, there was 11 bids on it, and we figured out how to finance it with some special financing that allowed us to win the deal, not just on price, but being able to close in 60 days, where most people were trying to assume the current financing, which would take much longer. So the seller picked us. When we sell that deal, it will be a 5x return to our investors over the life of the whole cash flow. We had a couple refinances along the way, and it's been a home run in every aspect.
Yeah, I think it's important what you said there is, it wasn't necessarily that y'all came in with the highest bid, but just the ability to solve a problem for someone. They wanted to get out of it. You said, well, I'll accelerate your timeline. You might take a little bit of a hit on the cost or the price that you're selling it for, but I can solve this problem. And y'all came in with the, like you said, the kind of creative deal to shorten that timeline. So that it's important every time you look at a real estate deal, it's not always cut and dry, whether it's, your financing, whether it's, how you're willing to take the asset. There's always a way to creatively set it up to where everybody wins.
Yeah,
In the
I
situation.
couldn't agree more. Oftentimes we've not been the highest price, but in this game, as you get bigger and bigger deals, the seller wants a surety of closing. And so if you've got the reputation with the brokers and the lenders as doing what you say you're going to do and closing on time and not retrading people at the last minute, if you keep that reputation solid, then you tend to win some deals there without being the highest bidder.
Yeah. So tell people as they reach out to BAM through the link in our show notes, what's going to happen to them? Kind of like what's the process? If you're interested in learning more, you want to look at the deals, you want to evaluate everything, kind of how take me step by step into how that works.
Yeah, thank you for asking. I love what we've done on the customer journey side of the house. So if you want to hang out and get educated, we've got an education platform with basics and medium and advanced curriculum. Some of my investors use it with their kids to teach them about real estate. And so folks can hang out and learn and watch content and read content, or they can skip all that and go directly to our team to do however deep of a dive they want on the due diligence. We've got folks that are gut investors, and we've got folks that bring in lawyers and accountants and family office teams and run us through the ringer and everything in between. But as we approach $2 billion, we've got to be able to have a lot of transparency and due diligence available for the sophisticated investors and families that come alongside us.
Now, does someone have to be an accredited investor, or kind of what's the minimum you have to put in whenever it goes to the funds?
Yeah, absolutely. All investors have to be accredited. It's not an offer until they've read the PPM, which allows me to advertise out there across the country and now beyond the U.S. So you've got to have $1 million in net worth or $200,000 a year in earnings. And then from there, we've got different strategies, anywhere from a $100,000 minimum to a $250,000 minimum across our development, acquisition, and private credit strategies.
Okay. And how long is your capital tied up in these as an investor? Like, is it a 3-year, 4-year, 5-year? I think that's the timeline people should be expecting.
Absolutely. The private credit fund is a 2-year lockup. So after 2 years, you can raise your hand and take your marbles and go home. The development deals are typically going to be a 2 to 4 year hold, depending on how long it takes to build them, lease them up, and sell them to one of the big guys. And then the acquisition funds are 5 to 7 year funds where we're buying thousands of apartments in that one vehicle. The last one we just closed, $175 million of equity, bought about $300 million of real estate, a little more than $300 million of real estate, 1,600 units across 6 communities in 4 different metros. And that'll be more of a 5 to 7 year hold, but that is the top as far as targeted returns.
All right. Well, fantastic. Ivan, as we finish here, is there anything else that I haven't asked you that you feel the listener should know?
Oh gosh, you've been so thorough. I'll probably think of something about 5 minutes after we close the recording here, but nothing comes to mind, Adam.
All right, fantastic. Well, if you want to learn more and potentially join the Bamily, the BAM fam, you can use the link in the show notes below and get connected with them and learn everything there is to know. Like he said, you can watch as many videos as you want, read as many papers as you want, but most importantly, it's time, I would suggest talking with them to educate yourself and really feel comfortable about getting in there. Just take action, get in there, talk with them, use the link in the show notes below, and you'll find out everything you need to know about the BAM companies. If you're sticking around and doing some single family investing, well, the place to find those is at renttoretirement.com. Like he said, eventually you can 1031 exchange into their world. If you're starting small and thinking big, you can start small at renttoretirement.com. Find our inventory there, schedule a call with us. And as always, if you have any questions for us, or if you want me to pass along any questions to Ivan and his team, you can email them to podcasts@renttoretirement.com. That's podcasts@renttoretirement.com. And if you want to tell your story, come on the podcast with us, tell your story. You can email that same one, podcasts@renttoretirement.com. Really appreciate the time y'all spent educating yourselves today. We'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.